We will start with the most important part of your business valuation chapter, that is cash flow based models. Okay, this is the most important part. Okay, and then your EV and MV also comes. It is also important. Okay, we'll see what it is. Free cash flow to firm method, that is value of firm is calculated using the following steps. So what are we going to do in this method is that in earlier method, what was it? It was earnings capitalization method. Okay, so what did we learn in this earnings capitalization method is that the value of the firm is being calculated using the earnings of the firm. Okay, but since earnings is not a valuable thing, okay, this earnings capitalization did not give effect to cash flow of the firm. Okay, it only took into consideration the earnings of the firm. Okay, cash flow was not considered. Okay, as the firm grows, it also introduces capital expenditure, right? And also the working capital increases. Okay, so this all factors was not considered in earnings capitalization method. So that's why a new method was introduced, which is cash flow to firm. Okay, this is the widely used method in the market. Okay, we'll see how it is calculated. First, what we'll take here is EBIT. Okay, if in question it is given as PAT, okay, then you have to do reverse calculation on it. Okay, PAT is how much? Let's suppose your tax rate is 30% and they have given PAT. Okay, so your PAT will be 70%. So your PAT divided by 1 minus 0.3, you will get the answer, right? You will get EBIT. Minus what we'll do? Why we are taking EBIT here first of all? Because this is cash flow to firm. Okay, it is catering to the whole firm. Okay, so to the whole firm, when it is catering, then what will be the value? Okay, for whom are we calculating? Only for equity shareholders? No, for the whole firm. Okay, there will be also debt holders in the firm. So to cater them, we are taking EBIT because EBIT includes their share of the profit as well. Okay, minus we are doing tax. Okay, this is the amount that is going from us. Okay, so we are deducting tax. Next, what we are doing is that when we deduct EBIT, when we deduct tax from EBIT, we'll get no PAT, net operating profit after tax. Okay, and then what we'll do is that we'll do net capex. Capex means what? Capex means your capital expenditure. Okay, as I told you earlier that whenever the firm grows, okay, whenever an organization grows, they incur a lot of capital expenditure also. Okay, but this is not valid. But this is not valid, right? Because when we are doing more capital expenditure, also we are getting a benefit of depreciation in that. No, so what we will do here is we'll do net capex. Okay, so capital expenditure minus depreciation, we'll get an amount here, right? So net capex will be capital expenditure minus depreciation. We'll have to reduce it. Okay, since this amount is going out of the firm, we are calculating cash flow. Okay, next, decrease or increase in working capital. Okay, so why are we now here? We have to add decrease in working capital and less increase in working capital. You know why? Because when working capital, what is working capital? It is, let's suppose, current asset minus your current liability. Okay, this we have studied so many times. Okay, current asset minus current liability. Okay, so if my firm is growing, okay, if my firm is growing, there will be more debtors, right? There will be more debtors included. Okay, because current asset also includes trade receivables, right? So since my debtors are increasing, which means what? I'm getting less cash in the business, right? So that's why what we'll do, if there is an increase in working capital, we'll reduce it, right? We'll minus it. And if there is a decrease in working capital, then I'll have more cash to spend. Okay, so that's why I will add it here. Okay, so what we'll get here is for free cash flow to firm. Okay, this we have got for 1 year. Okay, now what we are trying to find here is we are trying to find it for the whole period, okay, for the whole total decision we are making. So what we have to do is we have to divide it by KO, okay, that is your cost of capital of the company, that is your WACC, okay. We have to divide it by that, okay. Let's suppose like we have to do it like we do in PB, no, how much income do you get every year? Let's suppose 10, okay. So what was the cost of capital? Cost of capital is, let's suppose, 9%, okay. So I'm getting the value as 1.111, okay. So same concept is being applied here. So value of the firm is FCFF divided by Q, okay. Now another thing here is the firm will grow by a certain percentage in the future, okay. Let's suppose it will grow every year by 5%, okay. Since it is growing by 5% every year, then my required return will be less, because every year the it is going to be more, no, the growth will be there, okay. So I'll have to reduce it, okay. This formula is similar to your D1 upon KE minus G, right? The same formula it is. Here you have to substitute D1 by FCFF1, okay. What is FCFF1? It is D0 into 1 plus G, right? The same thing here also it applies, okay. Your free cash flow to firm was in the current year. For next year, if you want to take it, you have to do growth factor also, okay, plus, let's suppose 1 plus 5%, okay, divided by KO, that is, let's suppose something it is 12%, okay, and your growth percent is 5%, okay. So divide by 0.07 in the bottom, okay. So what we'll get is that value of the firm. Now we assumed here that it was perpetual cash flow at the start of the period, okay. Now what if there is uneven cash flow, okay. We have already learned this in security valuation chapter and basics of AFM, okay. If you have not seen that video, go and watch that video, okay. I have explained it there also. If there is perpetual cash flow, so with variable growth, so the period where there is variable growth we'll do PV, and the period where there is perpetual growth afterwards we'll add it, okay, by doing terminal value, by doing this step only, okay. And we'll get what? We will get value of the firm, okay. Now in some questions, okay, free cash flow to equity will also be needed to be calculated, okay. So what in the question they would have given is calculate the value of equity per share or whatever they might have given you, okay. So in that case what you have to do is that you have to just calculate value of equity. So how do you calculate value of equity? The first thing you will take is what is the profit attributable to equity shareholders? It is your profit after tax, right? So you have to take PAT, right? If they have given EBIT in question, okay, minus interest, minus tax, then you will get profit after tax, okay. Then what you have to do is normal thing, okay, minus net capex plus or minus your decrease or increase in working capital, okay. This is very much same like your the thing. Then you will get FCFE, okay. But here the catch is those are those capital expenditure or your increase or decrease in working capital only attributable to equity shareholders? Only they have to bear it? No, right? So whosoever has invested in the firm should bear that expense, okay. So it is borne by whom? Your debt holders also, okay. So what we'll do here is we'll take the weight of debt, okay. Let's suppose it is 30% in the company, okay, and 70% is your equity. So only 70% net capex will take for equity portion, right? So this is 1 minus debt ratio, okay. We'll do, let's suppose it is 30%, okay. So into 70% we'll do, okay, net capex, okay. So after that we'll get FCFE. So for FCFE what we'll do is that FCFE1 is what? FCFE1 is FCFE which you have got here into 1 plus G divided by KE minus G, right? Here we'll use KE because we are finding it for equity and not for the whole firm, okay. Even if in question if it is given for WACC, don't take it, okay. Calculate for equity alag se, okay. Next, if there is perpetual FCFE with variable growth, okay, it is the same concept as your value of firm, okay. No changes here, okay. You can do it very much. Next, There are some notes given here, okay, for your better understanding. What is it? We'll see. There are some notes given here. That is, if there is no debt, okay, if no debt is not given in question, then PAT is equal to your no PAT, okay, and FCFE is equal to your FCFF, okay. And if in question, if they are asking you to calculate incremental value, okay, due to adoption of new strategy, okay, they are saying that they are going to apply a new strategy and it will increase their cash flow, okay. So what we'll do is that value of firm after adoption of new strategy using FCFF method, okay, minus their existing value before the firm strategy, okay, that is existing NOPAT divided by KO, okay. So we'll get an amount, okay. This is very much basic, you'll understand when we are doing questions, okay. So this is the concept of cash flow, okay. We'll see another concept also, that is your relative valuation method models, okay. It's also very much short only, and then we'll move on to questions, okay. So what is relative valuation models? We'll see. Sales revenue or multiple method. Sales or revenue multiple method. So how do we do it is that we'll take sales multiple of a similar company in the industry and we'll multiply it with our sales, so that we'll get our value of the firm, okay. This is a simple logic behind it. So how do we take it? First, what we have to do is, first we have to take the sales multiple of different company, okay, of the similar company. So how it is calculated is equal to sales multiple is equal to enterprise value divided by your sales, okay. Enterprise value is your value of the firm divided by sales, okay. So what will be my enterprise value? It will be sales multiple of similar company in our sales, okay. Very much easy. Next, EBITDA multiple method. What is EBITDA? EBITDA is your earnings before interest and tax, depreciation and amortization. So depreciation, you know, it is charged on fixed asset. What is amortization? It is done on your softwares, okay, on your intangible assets. In this method, value of the firm is calculated using EBITDA multiple of a similar company, okay. The same thing we are doing here, okay. Enterprise value divided by EBITDA, okay. EBITDA multiple will get, what will be my enterprise value? It is equal to EBITDA multiple into EBITDA, right? Here we have to do some adjustment in EBITDA before using it in this formula, okay. So how do we calculate EBITDA? EBITDA is what? EBITDA is your net profit, okay. Profit, that is your operating profit, okay. Operating profit before paying interest, tax, depreciation and amortization, okay. So in that profit, if they have included extraordinary profit, extraordinary loss, okay, and expense pending to be written off, or your income pending to be recognized, if all these things are being added in there, okay, are given effect in there, then we should not take that, okay. So that is what is given here, your EBITDA minus your extraordinary gain. If it is included in there, we'll minus it. If it has already been reduced, that is your extraordinary loss, we'll add it back, okay, because these extraordinary items will not be occurred frequently in the future. Next, expense pending to be written off, okay. So any expenses like your sales promotion cost, okay, it is already a sunk cost, okay, but it is not been written off yet, okay. So we'll minus it. Next, plus your income pending to be recognized, okay. So that will add it. You can see like which one is not ordinary in the ordinary course of business. You have to just reduce it. Just keep these two things in mind: expenses pending to be written off, and the next one is your income pending to be recognized, okay. Income pending to be recognized and expense to be written off, you have to keep in mind for EBITDA, okay. Next, comparable companies multiple method, okay. So in this method, what we'll do is that we'll find value of equity using the 4 ratios of similar company, okay. There is only one question given in the question back, so that's what I'm saying, okay. We'll use the 4 ratios to find out of the similar company, to find out what? To find out our value, okay. So how do we do it? It is market value to book value, one ratio will be given. Okay, like that 4 ratio: market value to book value, market value to replacement cost, to sales, to net income. 4 ratios will be given. If all these ratios are given for two similar companies, then what we'll do is that we'll average it out. Okay, we'll average these two companies. Let's suppose market value to book value is given for two companies. Then what we'll do is that market value to book value for each company will calculate and we'll divide it by 2. Okay, we'll average it out like that for every company you have to do. Okay, for every ratio you have to do. Okay, next, then we'll calculate value of equity of our firm. Okay, so what we are doing here is we are calculating just value of equity and not value of the firm total. Okay, so there is only one question given here. So there they have asked us to calculate only value of equity. Okay, so market value of equity. So how do we do it? Is that we'll multiply the MV to book value, the average value which we have taken in step 1 in this thing. Okay, we'll multiply it with our book value. Okay, like that. For replacement cost, we'll multiply it with our replacement cost. Okay, so this is multiple only. Okay, so multiple we are doing it. Okay, and we'll get market value using each method. Okay, and we'll just average it out. Okay, average of all 4 ratios. So we'll get market value of our firm. Okay, so this is a good method. Okay, it takes average of all the factors into mind. Okay, it is a good method. Next we have is chop shop method or breakup value approach. Okay, what is chop shop? Chop shop. It is a method used to calculate value of the firm. Okay, value of the firm using various business segments. Okay, in this method, value of firm is calculated using the following 3 ratios for each of the business segment of a similar company. Okay, let's suppose there is 2 companies. Okay, Tata and Adani. Okay, they are engaging in various businesses. Okay, they have a multiple business model. Okay, they are engaged in various businesses. Okay, let's suppose Tata is engaged in textile, electricity, okay, and another industry. Okay, and Adani is also doing that only. Okay, in all 3 industries. Now what we'll do is that we'll take for each business segment. For each business segment, what we'll do is that we'll take capitalization to sales. Okay, 1 ratio we'll take, and capitalization to assets, capitalization to operating income, whatever they have given here. Here whatever ratio they have given here, you just have to calculate everything. Okay, so in first step what we are doing is that of similar company we are doing. Okay, capitalization to sales of similar company we will have to do. If there are they have given more than 2 companies. Okay, 2 companies they have given, you have to just average it out. Okay, that is the basic funda you have to apply. Okay, now capitalization to assets. Okay, capitalization to operating income, and any other thing they would have given, just calculate it. Okay, so what does capitalization mean here? Capitalization means your value of the firm. Okay, value of the firm or your enterprise value, whatever it is. So they have given a different name, that is capitalization. Okay, in chop shop approach. Now what we have to do is we have to calculate value of the firm. Okay, using the following steps. So what we'll do is that we have to calculate 3 different value of firm using each ratio. Okay, capitalization to sales, capitalization to assets into our assets. Okay, it is the same thing as your relative valuation method, but they have given chop shop approach because it is for each business segment. Okay, so value of a firm is equal to average of all 3 capitalization as calculated in step 1. Okay, we'll just have to average it out. Okay, divide by 3, we'll get chop shop approach value of the firm. Okay, so this was the total concepts of relative valuation and cash flow based models. Okay, now we'll do questions of it. We'll start cash flow method. Okay, so here we have a question. Following is information respect of XYZ, which is expected to grow at a higher rate for 4 years, after which the growth will stabilize. Okay, this is 2-step dividend discount model. Okay, like that only. Okay, you have to do valuation based on that. Next, Base year information, it is your revenue, EBIT, capital expenditure, depreciation is given here. Information for the high growth and stable growth period are given here. Okay, high growth is your variable growth, and stable growth is that afterwards perpetual cash flow will find it. Some risk-free equity beta, market risk premium, pre-tax cost of debt, debt equity ratio is given here. Okay, which means what? Which means to find out KD and KE is given here, and to find out KO is also given here. So now what you have to do is that for all time working capital is 25% of revenue and corporate tax is 30%. What is the value of the firm? They have asked. Okay, we have to find out value of the firm. Now looking at this data, I can guess that capital expenditure is given, depreciation is given. It is what? It is your cash flow method. Okay. So now for cash flow method, what do we need is that first we need free cash flow to firm, right? So how do we get free cash flow? We'll take EBIT, okay, because we are calculating it for the firm. We'll take first EBIT. What is my EBIT? EBIT is 300 crores, okay, minus tax. What is the tax rate? Tax rate is 30% minus 30%, right? 210 I'm getting as no PAT, right? So minus, now what I have to do is that it's a net capex. So 280 minus 200. So minus 80 I have to do. Okay. Next what it is? It is your minus your net capex minus your increase in working capital. Okay. So working capital for all time it is 25% only. Since we are calculating the base year's net profit, base value, so we won't take it. Okay. So this is my FCFF for the base year. Okay. Now what they have said is that now another thing we need is FCFF into 1 plus G divided by KO minus G, right? So what is my KO? I don't know my KO because I don't know KE. Okay, so can we find KE? Okay, risk-free rate is given 10. Okay, equity beta is given 1.15. Market risk premium is given. Okay, 1.15 into risk premium we have to do. Okay, this is not market return, it is market risk premium. Okay, into 6 plus 10. So my my ratio is, my KE is 16.9. Next what you have to do is we have to find out debt. Okay, so cost of debt, here they have given here pre-tax. Okay, so we'll have to do it post-tax. We'll have to reduce the tax benefit of it. Okay, minus 30%. So it is 9.1. Okay, so since the debt equity ratio is 1:1, we'll divide it simply by 2 plus 16.9 divided by 2. So my KO is 13%. Right. Now what you have to do is they have told us that it will grow at a higher rate for 4 years and after that it will stabilize. So this high growth period is for the next 4 years. Okay, I've got KO here. So what it is, we'll see. Okay, first what we did, we got 130 as FCFF, right? See here, high growth phase, I got my cost of capital as 13%, right? Now what you have to do is, next we have to calculate the FCFF. Okay, FCFF, how do we calculate? The first year. Okay, now what it is said here is, for all time working capital is 25% of revenue and corporate tax is 30%. Okay, and here they have given high growth and stable growth period growth. Okay, growth in revenue and EBIT and revenue will grow by 20%. Okay, so how it is calculated? So 2000 plus 20%. Okay, 2400 is the year one end cash flow. Okay, year one end revenue. Okay, but do we need to find revenue? No, it is not needed. Only we need revenue for finding cash flow. Okay, your working capital into 25% was my working capital. So okay, 600 it was. Now okay, now we have to find change in working capital. Okay, now 2000 into how much? earlier it was 25% only. Okay, they have said that working capital is 25% only. Okay, M minus MRC, I am getting it as 100. Okay, 100 is the change in working capital. Okay, now growth in capital expenditure and depreciation is also 20%. Okay, so my capital expenditure and depreciation will also grow by 20% only. Okay, so earlier we had 80 as the base rate, right? 80 as the base rate, 80 as the net capex, plus 20% will do, we'll get the second years. Okay, 96, right? So EBIT, if revenue is increasing by 20%, EBIT will also increase by 20%. It is given in question here. Okay, EBIT was 300 plus 20%. Okay, minus tax 30%, minus capex 96, minus my increase in working capital, right? My working capital is increasing, minus 100, right? So I'm getting it as 56. Like that for 4 years you have to calculate. Okay, now 4 years you have calculated. Okay, for 4 years you have calculated. Now you have to calculate for terminal year. Okay, now I'll just show you. Okay, how is it calculated? For 4th year, how do we take? Okay, 2400 was for the first year end. Okay, plus 20% if you do, you will get second year. Plus 20% you do, you get for the third year. Okay, plus 20% you do, you get for the 4th year. And for the terminal year means what? Afterwards it is stable as no, plus 10% you have to do, because it is growing by 10% only for the stable period. Okay, so 4561.92. Like that you have to calculate. Okay, now but here in terminal value, if you see, the capital expenditure are offset by depreciation. It means what is that your capital expenditure and the depreciation are equalized, because you won't do more capex afterwards, only you have to charge depreciation. So your capex and depreciation are equalized, right? There is no growth. So in no growth period, your capital expenditure and depreciation are offset by each other. Okay, so we won't take it. Okay, it is given in question, but if it is not given in question, you can take that assumption. Okay, now minus your change in working capital. Okay, that is your working capital increases, because your for all time working capital is 25% only. Okay, 25% it will always increase. Okay, so that's why we have taken it here. Next, we got year 1, 2, 3, 4. Okay, and we got terminal value. Now we have to do PV of it. Okay, so 56 into year 1. Okay, so what is the PV factor we'll take? First we'll take for high growth phase. Okay, because high growth phase we are taking, this is how much we got, 13%. And for the stable growth, how much was the KE? KE will be how much? Equity bid as 1 into 5 plus 9. Okay, so this is my KE. Okay, now my pre-tax cost of debt is 12.86. Okay, 12.86 into 0.7. Okay, so 9.002 is my this thing, what, debt ratio. Okay, after tax. Now debt to equity ratio is 2/3. Okay, which means what, your debt is 2/3 of equity. That is, your debt is 66%. Okay, into how much? Into 9%. Okay, it is 5.99. Okay, and this will be my equity portion into how much? 14%. So I'm getting it as 10.76%. No, two is to 3, no? So if my debt is 2 and my equity is 3, my debt should be 66%. Why they have taken it here 60%? This we got right, 14% and 9% we got right. But this debt to equity ratio 2 is to 3. Why we are not getting it? So 2 divided by 5. Huh? Yeah, man. You would have made a great blunder here. So here debt to equity ratio is 2:3. Means what? For 2 debt there is 3 equity. Okay. So how do we calculate? 2 divided by 5 is equal to 0.4 and 3 divided by 5 it is 0.6. Okay, just keep this in mind. It is very important. Okay. So 0.4 into how much? Into 14 into 9% and 0.14 into 6. So I'm getting it as 12%. Okay. Next, for stable growth, we have to take it for 12%. Okay, just keep this in mind. It is very much important that 2:3 is 2 divided by 5. Okay, because debt was 2 and equity was 3. Here it was equal. It was very much easy. Just keep this in mind. 2:3 means what? 2 divided by 5. Okay, because 2 was debt part and 3 was your equity part. Right? Interpret the question very well. Okay, for 13 PV, what we do is that 1.13 divided by 1, 2, 3, 4. Okay, for 4 years we got 0.613 we got. Okay, we'll do PV of it. We are getting 217.38. Okay, now for terminal value, what we'll do is that we'll have to find KE first. Okay, so how do we do it is that what is my terminal value? My terminal value is 375, right? 375.32 divided by KO minus G, right? What is my KO? My KO is 12 minus my growth is 10% minus, so divided by 0.02. Okay, so I'm getting it as 18,766 crores. Okay, but is this value right? No, this value is not right, because now what you have to do is we have to do PV of it. Okay, so what is the factor for PV? 1.12 divided by 1, 2, 3, 4. Okay, for the 4th year we'll take, because that is the base year, into, so 11,926 is my amount. Why have they taken it for 13? Yes, for 13 we'll take. Okay, for 13 we'll take, because for the 4th year the value was 13% only. For the base year we have to take it, right? So for the 5th year the base year is 4th year. So for the 4th year, what was the PV? It is 1.13. Okay, so we'll have to do it by 0.613. Okay, this is very much important, so keep this in mind. So the value of firm is 217 plus 11.503. We'll get it as 11,720.94. Right? Question number 8 is easy. You can do it yourself. Okay, there is nothing here. Okay, here they have given your growth rate is given. Okay, 20% it will grow and 8% is your stabilization rate. Okay, and revenues is given here, cost of goods sold. Okay, if you want to take EBIT, revenue minus COGS, okay, you will get EBIT, and do operating expense. Okay, so if you want EBIT, you will do what? Revenue minus COGS minus your operating expenses, you will get EBIT. Okay, and then what you have to do is that, see, you will get EBIT, you will take FCFF for year 1 to how many period is that? It is given for 3 years. Okay, so for 3 years we'll take, okay, EBIT 1 to 3, and 4th one will be your what? It will be your stabilized period, that is your terminal value. Okay, so EBIT we get. Okay, for the growth period it is 20%, and after that it is 8%. Right? Tax we'll get NOPAT. NOPAT minus your capex at 15%. Okay, why is it 15%? We'll see. See, during the high growth period, it will grow at 20%, and net capital expenditure will be 15%. Okay, from year 4 onwards, that is normal growth period, revenues and EBIT will grow by 8%, and incremental capital expenditure will be offset by depreciation. There will be no change in depreciation and capex. Okay, capex will be, net capex will be 0 only. Okay, so here they have told that capital expenditure will grow by 15%. Okay, so that's why we have taken here 15%, right? 15%. So do all of it. And next, during both high growth and normal growth, net working capital will be 25% of revenue. Okay, so how much my revenue will increase? It'll the EBIT, sorry, your increase or decrease in working capital will also be your increase. There will be only increase only. Your working capital will also increase by 25%, right? So that is what we have taken here. Okay, increase in working capital. If you have to do for the base year, you calculate. Okay, for the year 1 minus your base capital, base working capital you do, you'll get FCF. Okay, now FCF is for the base year. You have to do for the next year. What do you have to do? For uneven period you take, right? For uneven period you take, and for the final year, terminal year, what you do is that this is your terminal year, no? So take terminal value divided by K minus G, right? Plus your this thing. You have to PV it by this. Okay. So here in third year, what we'll do is that 2680 was a terminal value, right? 2680 was a terminal value. Now, how do we take what rate do we take here? 8% or what? No, we'll take KO. KO is given here in question. KO is given readily in question. Okay, so 15% only we'll take. Okay, here it was very much important. 13 and 12% was given here, so we have to take here 13%. Here it is directly given in question as 15%, right? Next, PVIF for 15% is given. They only have given here, so we'll discount it by using this rate only. Okay, corporate tax is given 30%. Estimate value of WXY using free cash flow to firm method and WSS method. Okay, it is very much easy. Okay, you can do it yourself. Next we have is question number 9. Okay, question number 9 is very lengthy. Okay, it is easy but it is lengthy. Since it doesn't usually come in exam, we won't cover it here. Okay, but if you want me to solve it, just comment it down. We'll see. Okay, no one will comment it down, but whatever. Okay, we'll quickly move on to question number 10. Okay, I'll just explain it to you and we'll solve it in the calc. Okay, if possible. Mr. X is a financial analyst, intends to value the business of PQR Limited in terms of future cash generating capacity. He has projected the following after-tax cash flows. Here, after-tax cash flow is given. So, year and cash flows are given here. So, this is what? This is your PAT. Okay. The terminal value of perpetual cash flow is estimated to be 92,340. Okay, so we need not calculate that at the end of 5th year. Okay. Now, what is required here? What is the value of the firm in terms of expected future cash flow if the cost of capital is 20%? Okay, first we'll do what? They have given here cash flows. Okay, cash flows already is given in question and terminal cash flow is given. So they are asking simply using cost of capital of 20%, what it is. Cost of capital of 20%, discounting factor is given here. Okay, 0.833. You can use this and we can find it. Okay, and for the end year, what we'll do? How much is 92,340, right? Into I'll do 0.402. Okay, so I'll get 37,120. Okay, I'll add it with the rest of the 5 years PV. Okay, so we'll get the value of the firm. Okay, so see here 37,120 plus the total of all the 5 years cash flows. Okay, next, the firm has an outstanding debt of 3620 lakhs. Calculate the shareholder value per share if the number of outstanding shares is 151.50 lakhs. Okay, so now what they are saying is that shareholder value per share. Okay, means what? Equity value per share. They're asking the value of the firm is how much? The value of the firm we got is 40,175.30, right? So minus, I'm doing 3620. Okay, so 36,555 should be my equity share value divided by 151.5. Okay, so I'll get it as 241.29. Okay, so this is the value per share. The firm has received a takeover bid from XYZ Limited at 225 per share. Is it a good offer? What is the value of the firm? Value of per equity share? It is 241.29, but they are offering only 225. So the offer should not be accepted. Okay. So it was a very much easy question. You can skip it. Okay. So we'll move on to question number 11, which is a good sum. It is based on reverse calculation. We'll see what it is. The valuation of Hansel Limited has been done by an investment analyst based on an expected free cash flow of 54 lakhs for the following year and an expected growth rate of 9%. The analyst has estimated the value of Hansel Limited to be 1,800 lakhs. However, he committed a mistake of using the book values of debt and equity. Okay, so what is this question saying is that the analyst of Hansel Limited has valued the value of the equity value of Hansel Limited as 1,800 lakhs. Okay, so they have also given us cash flow and growth rate. Okay, but he committed a mistake of using book values. Okay, we need market value of the company and not book value. Okay, so the book value of weights employed, the book value weights of the weights employed of the analysts are not known. Okay, the book value weights are not known, but you know that Hansel Limited has a cost of equity of 20% and post-tax cost of debt as 10%. Okay, the market value of equity is thrice the book value, whereas the market value of debt is 9/10 of its book value. Okay, what is the correct value of Hansel? Okay, we'll solve this question. Okay, right now you might see it as what it is given here, but once we write the sum, we'll see. Okay, we'll get to know. The first thing what they have given here is question number 11. They have given us is cost of equity and post-tax cost of debt. Okay, but the weights is not given. Okay, the book value weights is not given. Okay, so for KO we cannot find it KO. Okay, so now what we need to do is that the market value of equity is thrice its book value, whereas the market value of debt is 9/10 of its book value. What is the market value of equity is equal to 3 times the book value. Okay, and market value of debt is equal to 9/10 of book value. Okay, we know this information. Okay, KE is given. KE is given as 20% and KD after tax, okay, is given as 10%. Okay, now what do we know here? The value of firm is equal to 1,800 lakhs. Okay, how do we calculate value of firm? Value of firm is equal to, see, what is the value of firm? Value of firm, what is it? It is cash flow. Okay, so we'll denote it as FCFF1. Okay, for the next year divided by KO minus G, right? It should be KO minus G, right? Because it will be growing, right? Now, do we know KO? We don't know KO, but the cash flow for the following year has been given. That is 54 divided by KO minus G is how much? 9%, right? So, if we solve this, we'll get answer as how much? KO minus 9% into 1,800 is equal to 54, right? So, if I want to solve it, it will become 1,800 KO minus 162 is equal to 54. Okay, so KO is equal to it is equal to 12%. Okay, my KO is coming as 12%. Okay, we are just putting in the data. Okay, So we got KO as 12%, right? So next what we need to do is that we have found KO. Okay, now we have to find the market value of the firm. Okay, so we got KO. What is KO? KO is equal to weight of equity into KE plus weight of debt into KD, right? So KO is given as 12%. Weight of equity is not given. Weight of equity is not given. Okay, KE is given 20%, right? Plus weight of debt is not given into KD is given as 12%. How much? 10%, right? Okay. Now we'll solve this equation. Okay, weight of debt is equal to 1 minus KE, right? So we'll use it. Sorry, 1 minus weight of equity. Okay, so 12% is equal to weight of equity into 20% plus weight of debt is how much? 1 minus weight of equity into 10%. Okay, if we solve this equation, we'll get, I'll just do 12. Okay, weight of equity 20 plus 10 minus 10 weight of equity. So 12 minus 10 is equal to weight of equity 10. Okay, so weight of equity is equal to 2 divided by 10. Weight of equity is equal to 0.2. Okay, weight of equity is equal to 20% and weight of debt is equal to 0.8, right? Is this what we are getting in the answer? Yes. Okay, so I got weight of equity as 20 and weight of debt as 8.8. Okay, now we'll find the market value of the firm. Okay, now what is market value of equity? Market value of equity is equal to thrice its book value, that is 0.2 into 3 times. Okay, so what is market value of debt? It is 0.8 into 9 by 10. Okay, so 0.2 into 3, I'm getting it as 0.6 and 0.8 into 9 by 10 is equal to 0.72. Okay, so this is my market value. Now I'll have to multiply it with the this thing, weight of, sorry, KO. Okay, so we don't know. First we had KO of earlier only. Okay, it was book value weight. No, now we'll find out the actual KO. Okay, how do we derive KO? KO is your weight of equity. First we used book value weight, now we'll use actual weight. Okay, so actual KO as per market value, what it is, market value of equity, it is, sorry, 20% is the cost of equity and how much? 10% is the cost of debt, right? 10% into how much? 0.6 divided by weight should be always equal to 1, right? Since here it is not 1, we will use the total of it. Okay, what is the total of it? We'll have to make it 1. Okay, so we'll just do in ratio. Okay, so 0.6 plus 0.72, it is 1.32. Okay, 1.32 divided by 1.32. Okay, so we'll get it now. 0.6 divided by 1.32 into, so my actual weight was how much? 0.45 into 20%, it is into 100. So 9.09 plus it is 5.45. So what is my actual KO? Plus 9.09, it is 14.454. Okay, my actual K is 14.54. So what is my market value? Sorry, what is my value of firm? Actual using market value weights, it is 54 divided by 14.54 minus 9%, right, is equal to it is 973.93, right? So is that the answer we are getting? Yes, 974.73, but we are getting 973.93. This much difference is fine. Okay, 9.09, right? 9.09. Okay, so if we do, we'll get this same answer. 14.54 minus 9.09 divided by 100. We are 14.54 minus 9.09 divided by 100. So 54 into, okay, divided by much. It is 990 only, 990.82. Okay. So this much difference is okay. Okay, earlier it was very much fine, 973, only 1 rupees difference was coming. They are given here total as how much? Sorry, it's only 9%, no, not 9.9%. 14.54 minus 9 divided by 100, 54 divided by, it is 974.72, 73, okay. It is growth only, okay. Now 12th is easy. I'll just read out the question, you'll understand. Okay, so in question number 11, what we did is that they had asked us that what was given in the question. In question it was given cash flow was given for the following year. Okay, growth rate of 9% was given and Hansel Limited was given. Okay, the book value. So now first what we found is that we had to find KO. Okay, by using KO we are finding out the weight of equity and weight of debt. Okay, now another information was given is that market value was thrice of book value of equity and KD was 9/10. Okay, and we found out actual weight. Okay, actual weight, how do you find it? Because the weight is 1, so 0.6 divided by the total weight, okay, of market value. Okay, we found out, we got the answer as 14.54, and using that we are finding out value of firm, that is 14.54 minus 9. Okay, it will be in the denominator, and in the numerator it will be 54. Okay, so we are getting 974.73 as the answer. Okay, so it was a very good question. Just mark it. Okay, it is a good question, mark it. We'll move on to the next question, question number 12. Sorry. Calculate the value of share from the following information relating to the year which has just ended. Okay, now we have to find out value of the share. PAT is given. Okay, very good. Equity share capital is given. Very good. Par value of share. Par value means your face value. Okay. Debt ratio is given. That is debt upon debt plus equity as 27%. Okay. So what will be my equity ratio? It will be 1 minus 27%. So long run growth is given as 8%, beta is given, risk-free return is given, market return is given, capital expenditure per share is given, depreciation per share is given, change in or increase in working capital per share is also given. Okay, now what you have to find is that calculate the value of the share. Okay, now we just have to find out value of share. Okay, for that we'll use what? PAT. Okay, PAT we'll use, and minus which method are we using now? We are using the method of this. What is this method called? That net capex and something. Free cash flow only, no? Yes, cash flow method only we are using. We'll minus net capex and increase or decrease in working capital. Okay. Now what it is, we'll see. First, profit after tax was how much? 290 crores. Equity share capital was how much? equity share capital is 1300 divided by par value of the share divided by 40. So how many shares are we having? It is 32.5 crores. Okay, 32.5 crores shares we are having. Now 32.5 crores of share we are having. Now how do we use that information? I'll just write it out now. It will be easier. We have to find what? We have to find value of share. Value of share, right? So how do we find it? It is first we need PAT, right? PAT and amount we need. Okay. Next what we do is that divide by number of shares. We'll get EPS, right? So after EPS, earnings per share we are getting. Now we need to find out what? Find out value of share. Okay. So minus what we do? So what they are asking is FCFE they are asking. Okay, they are asking FCFE. FCFE, how do we calculate it? First we do what? PAT, right? PAT. There is no tax. Okay. Minus net capex. Minus increase in working capital. Okay. Increase in working capital, we have to reduce it. Now, what is my... So how do we calculate FCFE? It is PAT. What is my PAT? My PAT is 290, right? 290. Now what is my net capex? They have given us per share basis only. Okay, so we'll take per share. Okay, so PAT, what is PAT per share? That is EPS only. Okay, so how much was my PAT? My PAT was 290. What is my total number of equity shares? That is 2.5. How did we arrive at this? 1300 divided by 40. Okay, par value of share is given 40. So we are getting this. Okay, now what is EPS? 290 divided by 3.5. 32.5, right? So I'm getting it as 89.23. Okay, 89.23. Sorry, 8.923. Right, 8.923 as my PAT. 8.923. Net capex is how much? 47 minus 39. 47 minus 39. Because my capital expenditure per share was 39 and my depreciation is 30. Sorry, my capital expenditure was 47 and my depreciation is 39. So 47 minus 39, I'm getting it as 8. Increase in working capital, we have to less it. How much is it? 3.45 per share. My goodness, we are going in loss only. Okay, we are getting it in minus. But is this amount right? This amount is for the total. We are just finding FCFE. Okay, so we have to reduce the debt part into how much was the debt? 1 minus 27%, right? 0.27. Okay, into 1 minus 0.27. Okay, that part the debt will pay. We have to just calculate for equity part. Okay, so 8 into 1 minus 27%. So it is 5.84, and here 3.45 into minus 27%. It is 2.5185 plus so 0.5645 is the answer. Okay, so what it is? FCFE. Okay, value of equity per share. Sorry, this is a FCFE per share. Okay, now we have to find out value of firm. Sorry, value of equity, right? Value of equity is equal to how much? FCFE 0.5645 into what? into 1.08, right? Divided by KE. What is my KE? Is KE given in question? No, KE is not given in question. We have to find it out. So how do you find KE? KE is risk-free rate plus risk-free minus market return into beta, right? So 10.3 so it is 8.86. KE is 8.86 minus what is the growth? It is 8%. I'm getting it as 70.89, okay, rupees. Value of equity per share is how much? 70.89. So is this matching with the answer? Yes, it should match. 70.91. Okay, it is very much close. It's fine. Okay, so next we'll move on to question number 13. It is also easy. So how it is, we'll see. ABC company is considering acquisition of XYZ Limited, which has 1.5 crores shares, 1.5 crore shares outstanding and issued. The market price per share is 400 at present. ABC's average cost of capital is 12%. Okay. The market information from XYZ indicates its expected cash accruals for the next 3 years. Okay. So next expected cash accruals is given here. Okay. That is your free cash flow to the firm. Calculate the range of valuation, that is value per equity and its total firm from the given methods that ABC has to consider. PV of 12 factor is 1 to 3 0. This is given. Okay. So now what we have to do is that firstly they have asked us to calculate the range of valuation. What is range of valuation? It is value of equity per share and total. Okay, that we have to find it. So which method do we need to follow here? It is the cash flow method only. Okay, so 1.5 crore shares are outstanding. Okay, we'll find out per share and total value. Okay, so we have to first multiply it with the PV factor, and terminal value is given. No terminal value is given, we have to find it out. So 250 into 0.893, 300 into 0.797, 0.712 into, so 747.15 crores is the total value. We cannot find out terminal value because there is no growth factor given here, right? If there would have been given a growth factor, then we would have considered terminal value also, but it is not given, so we will not take it. Okay, so 747 is the value. Okay, now per share what it is, divided by how much? 1.5. So it is 498.1. Okay, so 498.1 per share is what we are getting. Okay, now we have to calculate the range of valuation. Okay, so what other method can we use? Market price is given. Okay, 400 is given, and we can find total value of equity. Okay, 400 into 1.5 crores, it is 600. Okay, so 600 crores is the total value of equity and 400 is the individual value. Now we have to calculate, now we have to compare. Okay, we'll compare. Minimum it is 400, maximum it is 498, total it is 600 and 747. Okay, so that was fairly an easy question. Now question number 14 is good question. Okay, 14 and 15 are good question. Okay, AB Limited is planning to acquire and absorb the running business of XY Limited. The valuation is to be based on the recommendation of merchant bankers, and the consideration is to be discharged in the form of equity shares to be issued by AB Limited. Okay, so AB Limited is planning to absorb XY Limited. right? So AB Limited is the acquirer and XY is the firm which is ready to be acquired. As on 31/3/2025, the paid up capital of AB Limited consists of 80 lakhs shares of rupees 10 each. Okay. Paid up share is given. Highest and lowest market quotation in the last 6 months were given as 570 and 430. So which price will take? We'll take average price. 570 plus 430 divided by 2. Okay, so 500 is the average value. For the purpose of exchange, the price of share is reckoned to be the average of highest and lowest. Okay, so we did already. XY's balance sheet is summarized as below. Okay, so share capital is given as 20 lakhs. Okay, loans is given, fixed asset is given, net current asset is given. Now what you have to find is that an independent firm of merchant bankers engaged with the negotiation have produced the following estimates of cash flows from the business. Okay, the cash flow is given here. Okay, it is the recommendation of merchant banker that the equity of XY Limited may be valued on the basis of average of 1 aggregate discount at 8% and net asset value. Okay, they have given us two methods, that is aggregate of discounted value, that is we have to take this, and net asset value. What is your net asset value? Net asset value is your share capital plus reserves in surplus, right? Or else you can take it as total assets minus your liability, 100. So we'll get the same answer. Okay, so we have to do average of this. Okay, so that is what they have asked us. So how do we solve it? Firstly, we have to do PV of this, all of this. Okay, so how do we calculate? We'll see. Firstly, we'll do net asset value only. It is easy. Okay, so how do we calculate net asset value? It is share capital, total assets minus your liability. So 350 minus your loans, that is 100. So it is coming to 250, right? 250 is your net assets. Plus there is no contingent liability, so we need not reduce it. Okay, so value of equity, calculate the total value of equity of XY Limited. Okay, this is the first thing we have to do. Net assets is 250. Okay, so we got that. Next, discounted cash flows at 8%. So how will we do it? So 105 into how much? 0.93. So only two point is given, so it is very much easy. 120 into 0.86. So terminal value into the previous year's PV, okay, into 0.68. So I'm getting it as 592.40. It is very much easy. Okay, so plus 250 divided by 2. Okay, so 421.2 lakhs is the average value. Okay, so this is the what they have asked. Total value of equity shares, total value is given. Number of shares to be issued to AB Limited. So how much should we issue to AB Limited? Okay, now AB Limited has 80 lakh shares, right? 80 lakh shares of rupees 10 each. Okay, divide by we have to take average value. Okay, for exchange purpose, what is the value of AB Limited? We have to find out the value. Okay, exchange value, how much is it? So it is 500, right? We calculated it as 500. So it is 0.8424. Okay, crores, lakh shares. Okay, into 1 lakh. So it is 84,240 shares we have to give to XY Limited. Okay, on the basis of allocation of shares, among the shareholders of XY. Okay, so how much shares should we give to XY Limited? Okay, that we have to find out. Okay, so how do we calculate it? Now XY Limited share capital is given here. Okay, 20 lakhs is fully paid. Okay, so we'll give them full amount. Okay, so into 20 divided by 30, right? Should we do it like that? No, we'll take it in the basis of this. 84,240 into 200 divided by 250. 67,392 should be given to the fully paid, and minus 84,240 should be given to normal shares. Okay, they have paid half. Okay, partly paid. Okay, it is a very easy question. We can do it. ABC Company Limited is considering a new sales strategy. They want to know the value of new strategy. Following information relating to the year is given here. Okay, ABC Company is considering a new strategy. Okay, the income statement is given here. Okay, 20,000. This is for the base year. Okay, relating to the year which has just ended is given here. Okay, this is for the base year. Okay, for the base year, the sales is for 20,000. The gross margin is 4,000. Okay, everything is given here. Admin, PBT, tax, PAT is given here. Balance sheet information is also given here. Fixed asset, current asset, equity. Okay, so if you want to take net assets, it is fixed asset plus current asset, right? Now, if it adopts new strategy, sales will grow at the rate of 20% per year for 3 years. Okay, if it adopts a new strategy, the sales, that is 20,000, right? It will grow by 20% for the next 3 years. Okay, 20,000 plus 20% plus 20% plus 20%. Okay, it will grow by this much amount for the 3 years. From 4th year onwards, the cash flow will be stabilized. Means what? The sales will remain the same. The net profit ratio, asset turnover ratio, and income tax rate will remain unchanged. Okay, so what they are trying to say is your PAT will remain the same. Okay, means what? The same ratio is being followed. Okay, so how much is the total? So for 20,000 it is 1,400, right? So 1,400 will also grow by how much? 20%. Okay, asset turnover ratio. Asset turnover ratio means what? Your fixed asset plus current asset, that is your total asset, to sales. So your asset turnover ratio means what? Sales divided by your total assets. Okay, total assets divided by sales. That is how much? That is your sales divided by total assets, right? It is how much? 20,000 is the sales divided by 12,000. So your asset turnover will remain the same. That is 1.67 will remain the same, and income tax rate will remain unchanged. Depreciation will be charged at 10% of the value of net fixed assets at the beginning of the year. Okay, at the beginning of the year only they are charging. So means what? So after this, when we are doing, see how much will my fixed asset grow? See, 12,000 is the amount. Okay, so how much? 8,000 is the amount of fixed asset. Okay, it will also grow by how much? The same percentage. Okay, so into 1.67. So it will, the next time it will grow by how much? It will grow by 5360 in the next year. Okay, and plus the next year it will grow by another 1.67. Okay, into the ratio should remain the same, right? So 24,000 divided by 12,000. 24,000 divided by 1.67. So this should be the amount into how much is the into 8 divided by 12. 9580 should be the next year's amount. I'll explain it to you. Okay, we'll just read the question first. Depreciation will be charged at the rate of 10% of face value of the net fixed assets at the beginning of the year. Okay, at the beginning of the year they will charge it. Okay, not at the end of the year. the company's target rate of return is 15%. Okay, means what? KO is given. Okay, KO is given. Determine the incremental value due to adoption of the strategy. Okay, this question is purely based on your ratios only. Okay, so accounting is very much important here. Okay, your fixed asset value is all important here. Okay, so this question is a good question. So this asset turnover ratio, now how do we take it for the whole company? How do we take it? Here there is no debt. Okay, if you see the balance sheet information, there is no debt. Okay, it is purely equity based company. So what are we trying to find here? We are trying to find FCFE and not FC for the firm. FCFF not, we are not finding, we are finding FCFE. Okay, for equity we are finding. Okay, so what we'll take? We'll take PAT. Okay, 1400. Okay, 1400 will take PAT minus what? Capital expenditure. Capital expenditure minus depreciation. Okay, so for the first year there will be nothing. Okay, for the first year there will be nothing. We have to find new strategy. Okay, so 1400 plus 20% only it will grow, because it is growing in the same rate. Net profit ratio will remain unchanged. Okay, so 1680. Okay, M plus. Now the main thing is your fixed asset and current asset. How much will it grow? Okay, what is my asset turnover ratio? My asset turnover ratio is how much? 20,000 divided by 12,000. Right, it is 1.66667. Okay, so this is my asset turnover ratio. So if I take in the question number how much? Number 15. Question number 15. Asset turnover ratio. How much it is? 20,000 divided by 12,000. Right? So it is how much? 1.67. Okay. But here also there is a catch. Okay, fixed asset and current asset, they are growing at a different rate. Okay, so what we have to do is, this is total asset turnover ratio, right? So we need fixed asset turnover ratio differently and total asset turnover ratio differently. Okay, so fixed asset turnover ratio, why are we doing this? Because if asset turnover ratio is remaining the same, so fixed asset turnover ratio will also remain the same, right? Fixed asset turnover ratio is how much? 20,000 divided by 8,000. That is equal to, it is 2.5. 2.5. Okay. And current asset turnover ratio is equal to how much? 20,000 divided by 4,000. It is equal to 5. Okay. So we got this ratio, we got both this ratio. So what we are going to do is, we are going to see for every year. Okay, so for every year we'll put the table. Okay, 1, 2, 3 and 4. Okay, now sales. Okay, we just need sales. So for the first year it is 24,000. For the second year it is how much? 24,000 plus 20%. It is 28,800. And for the third year it is 34,560, and for the fourth year also it will remain the same. Right, now we'll get all these gross margin, admin, it is all the same, tax rate is also same, so we'll directly take PAT. Okay, we'll just put an underline here. We just need that information for some reason, so that's why we are taking it here. Okay, if you skip it also there is no problem. Plus 20%. 1680. I just have to show it for the fixed asset turnover ratio and current asset turnover ratio. For that I have written it here. Okay, plus it will remain the same in the terminal year, right? Now what we have to do is minus net capex, right? minus net capex we have to do, right? But for this, what we need is it, first thing is the addition in fixed asset, right? Okay, minus depreciation, will get a figure. Okay, this is my net capex, and minus or plus increase, it will be increase only. Okay, so we'll less it only, increase in working capital, we'll less it differently. Okay, so first addition in fixed asset. How much addition are we doing in the fixed asset? So firstly, what is the ratio? It is 2.5, right? Means what? Now 24,000. So if I put it here, I'll show it in the working note. Okay, working note differently I'm doing. Okay, for the first year. So what we are doing is that 24,000 is my sales, right? Divide by what is the asset? It is, I don't know. Fixed asset I don't know, is equal to how much? 2.5, right? So fixed asset is how much? Fixed asset is equal to 24,000 divided by 2.5, that is equal to 9,600. So how much addition am I getting? It is 8,000 minus 9,600. Okay, minus 8,000, I am getting it as 1,600. Okay, so 1,600 I'll put it here. Okay, same way for the next year. Okay, so how much is it? 28,800 divided by 2.5. Okay, minus 9,600, right? So it is 1920 for the second year. Okay, so for the second year, how much was the amount? It was 11,520 for the next year. For the third year, how much will it be? 34,560 divided by 2.5. It is 13,824 minus 11,520. It is 2,304. From the fourth year onwards, there is no growth, so there will be no capital expenditure also. So I am assuming it as 0 only for the fourth year. Next, depreciation. Depreciation is what? Depreciation will be 10% of the face value of the net fixed assets at the beginning of the year. Okay, means what? We have to do 10% of the value. So 9,600 into how much? 10%, right? So 960 is my depreciation. For the whole thing we are doing, no, 1920 into 10, 11,520 into 10%. It is 1152. The third one, it is okay, this is the depreciation amount. Are we going right? Yes, I suppose. See, we have created a ledger roles only here. Okay, we have directly created a ledger here to calculate capex. So for the first year we are getting how much? 2,400. Am I getting that? we are assuming what is that it is, since it is in the beginning of the year, so since it is in the beginning of the year and we are doing what, we are doing capex at the end of the year. Okay, so for the first year what will happen is that the depreciation will be 8,000 into 10%. Okay, so it is how much? 8,000 into 10%. Okay, in the first year, so it is 800, and here it is how much? 960, and here it is 1152. Okay, so how much will I get? The amount 1600. So I'm getting it as 800 for the first year. No, total only 1600. Okay, I found out the mistake we were doing. Okay, so the thing it is given here, it is inclusive of depreciation. Okay, inclusive of depreciation is given in the question. Okay, so here we have already taken into consideration what we have already taken these into consideration. Okay, 8,000 is after depreciation. Okay, so that's why we were getting the total figure as the same only. Okay, 1619202304 is after depreciation. So this is the net capex. Okay, so this is the net capex. Now we have to just do increase in working capital. Okay, so increase in working capital is how much? We'll do a second note, working note. It is what? It is for increase in working capital. Working capital, how much is it? For the year 1, 2 and 3, we'll calculate how much is it? 24,000 divided by how much? 5, right? And here 24,000 divided by 5, it is 4,800. Okay, so how much is it increasing? It is increasing by 800. And here it is almost 28,800 divided by 5, 5760. And here 34,560, 6912, and for the fourth year it will remain the same, 6912. There is no increase. Okay, so increase is 0 here. So it is 960 here. $1152 here. Okay, if we do it, we'll get the answer. Okay, proper. It is minus only here. So how much is the FCFF? FCFE only. Okay, FCFF and FCFE will be same because there is no debt in here. Okay, minus 1600 minus 800. So it is minus 720. I'll put it in bracket. 1920 plus it is 864 positive 24. It's all in negative only. Okay, the third one will be how much? 2419. It will be positive because there is no additional expenditure. Okay, so we got FCFE, right? We got FCFE. Now what we have to do is we have to just do PV now. Okay, into PV. How much is the PV? At the rate 15%, right? Company's target return is 15%. So 1.15 divided by 1. 0.869 6. Zero point 0.7561, 0.6575. Okay, so this will not do. Fourth year will not do because it's terminal year. We have to just take it under it. $720 into 0.8696 to 626.112. 864 into 0.7561, it is 653.27. it is all in negative only. Okay, 10036.8 into 0.6575 to 681.696. okay, negative. And for the final year it is, you have to take the total. Okay, now what is the total PV total for every year? Okay, for 1 to 3 year it is how much? 681.6. it is 1961.078. okay. Total PV, it is residual value, that is terminal value. Terminal value, what we'll do? Terminal value we have to K minus G, right? So growth is how much? Growth is 0 only after that. So 2419, we are taking terminal value 2419.2 divided by KE minus G. So it is 15% minus G. Minus G is not there. Okay, so minus 0. So how much is it? 2419.2 divided by 15%. 16128 into how much? Into your previous year's PV, that is 0.6575 into 0.6575. So I am getting it as 10,604.16. okay, if we add it, total cash flow, it is how much? 10,614 minus 1961.078. This 8643.082. okay, now we have to compare. okay, so what was the earlier strategy? Earlier strategy, it was how much? Pre-strategy, we were getting how much? 1400 divided by 15%. how much we were getting? We were getting it as 9333.33, but since we are getting less here, okay, loss due to strategy, how much are we incurring loss? 96. We are incurring a loss of 690.25. okay, so this was all about cash flow. okay, practice well and we'll see you in the next lecture. Tata, bye bye.